3rd. But first, when we're talking market action today on this show, we are talking Lyft because it kicks off the tech IPO wave. The ride-hailing company, you can see there, began trading on the NASDAQ a little over an hour ago, opening at $87.24 a share with a nearly $30 billion valuation. We can see shares right now, if we check where they are trading, you can see they've come down a bit from where they opened, but still in the green, up from that IPO price, which we saw listed yesterday. But guys, our Yahoo Finance's Ines Ferre is at the NASDAQ right now watching this all unfold as we see the market action worsening for Lyft. Ines, what are you seeing down there?
Yeah, Zach, well, I was just speaking with Jeff Thomas. He's head of the Western U.S. listings here at the NASDAQ, and I was talking to him about this IPO. He said, look, this is a unique celebration. He told me that the NASDAQ had really built up this relationship with Lyft so that they would list on the NASDAQ, and the stock, as you mentioned, it opened at $87.24. It's just slightly above 80 right now. And when I asked about why such a strong interest and excitement on a company which isn't profitable yet, he said, he told me it's brand awareness, that the consumer has heard of the company, people have heard of ride sharing, and investors are just willing to invest in the future in growth. As for some of the other IPOs that are coming up, he spoke to me about Zoom. He expects that to do well, and that company is profitable. So we're keeping an eye out for that in the coming months. Zach?
Was there any sense of nerves down there? It was supposed to start trading at around 10:45 Eastern time. It was a little bit delayed. Was there any reaction to that?
Oh, yeah, certainly. I mean, there was nerves about when exactly this was going to start trading and really at what price. You had the first indication coming in at 90, and then it was 87 something. So it basically, there was anticipation. And I would say that that's really been sort of the whole feeling here all week, is anticipation about this IPO.
All right, Ines Ferre down at the NASDAQ. Thanks so much. We'll check back in with you later. Joining us now for more insight is Flat World Partners CEO Anna Marie Wascher. Anna Marie, you were an early investor in Lyft.
Yeah.
Back when the company was valued at $3 billion 5 years ago. You invested again when the valuation jumped up to 7.5. Now we're seeing it valued at around $30 billion. So what was the original investment thesis in Lyft, and how much of that remains intact at a now much bigger valuation?
Sure. So at Flat World Partners, we focus on sustainability as our core thesis and impact. And so as we were looking at innovation for electric vehicles, smart city infrastructure, we actually landed at ride sharing at the core of innovation for sustainability in cities. And as we evaluated some of their main competitors, we actually wrote a pretty strong thesis that Uber would fail or have a lower valuation based on governance and social issues within the organization. And for Lyft, we felt like that the social initiatives that the two founders were focused on, as well as how they've built out the team since, really changed the way investors would see them in the long run and consumers would see them. And I think we've really seen that thesis play out. And in public markets, I think that more investors that are really aligned to ESG and sustainability are going to continue rewarding these types of firms in public markets.
Anna Marie, when it comes to adult Americans who've actually taken a rideshare vehicle, Pew Research says that it's 36% of adult Americans that have taken either an Uber or a Lyft or something along those lines. Do you think the competitive advantage is there for Lyft because of its domestic focus?
I think it's not just the domestic focus, but they're really focusing on ride-hailing as their core model and future innovation in transportation, where companies like Uber have forced expansion in global markets through acquisition and really struggled when they tried to grow organically, as well as moving into actual other business lines. Uber really is not a ride-hailing business anymore. If you see the number of driver's licenses, there's been substantial decline. So Lyft hasn't even targeted their main market, which are the up-and-comers and millennials that no longer buy cars or even know how to drive.
And there's Uber Eats as well to differentiate there too. So there's a lot of different things that set these companies apart.
Yeah, I mean, I understand like the idea of Lyft has always been sort of the underdog good guy in this race. But my question now is, at this number, I mean, you guys, I mean, how tempting is it just to sell like a huge amount?
Well, early investors have to hold for 6 months anyways.
Yeah,
but
that's why I mean the temptation.
I don't have a temptation to sell, because if you look at the growth that Lyft's been able to achieve, they still doubled revenue, and we're over 100% growth in the last year. I know there's a lot of discussion around the growing net losses, but that only grew by 32%. So that's a significant difference. And in fact, that's more of a venture model to really infuse capital into market share focused strategies and marketing generally. Lyft's team and CFO have always really been thoughtful about that, and I think you'll see a really fast tightening of kind of net losses.
I want to dig a little bit deeper into that point there, though, that Thornton's raising, because you're right. I mean, net losses, I think, surprised a few people when it came in at 911 million last year, because it looked a little bit bigger. But obviously, if you're going to race Uber to the public market, you're going to want to try and show that you're growing. And then, indeed, to your point, 100% growth on the revenue side is impressive. But just when we talk about valuation, and it's funny because people always complain about how do you value these companies when they're operating at a loss. But if you look at some of the competitors, right? Not competitors, but let's look at the competitive set when we talk about some other tech companies out there who are losing money as well. Farfetch and Etsy compare pretty closely when we talk about price to sales ratio. But Lyft is up there with those. Is it fair what we're seeing right now with the pricing where it did in your mind? And do you think that it's fair to be looking at these tech companies that way, from price to sales?
I would say for the most part, it's not fair. I think Lyft at the core is still an operating business that doesn't sell marketing, and that there's plenty of other transportation venues they can move into, from last mile transportation, partnerships with delivery systems that they haven't really explored. And so from a growth perspective, we're paying valuation on growth, not just what the business is currently worth today. I do think technology companies broadly do get overvalued on growth often, but if you look back at Amazon and Facebook, they had the same criticism, and now you would have said, well, that was a steal at that price.
Sure.
I mean, Amazon and Facebook are nice comparisons, but I mean, I think also when I think about Etsy, I also think about Snap, and I think of Blue Apron. I think about this new tranche of companies that have gone public at these wild valuations. And the other thing that's a symptom that I think Lyft plays into is these voting shares, where you're saying, hey, we're not making money, but the good news is you'll never force us to make money because we're going to hold all the power. As a shareholder, I mean, are you all discomfited by the fact that you can't tell John Zimmer, I'm unhappy with what's going on, or you can't tell him, but you can't do anything about it?
I think that comes down to the culture of a firm more than anything else. I think in certain regards, how Flat-Rolled approaches investments broadly is we're a little counterintuitive. We don't like large valuations. We want to think about authenticity when we're looking at who has control over the growth and success of the business. Yeah, I do think the two share class is concerning, but from the culture of Lyft, they are now empowered to grow for the long run and not be forced by short-term views of shareholders that are looking for that growth in numbers quickly, which is also the same process in venture capital. And how we've always interacted with senior management has been supportive, regardless of our control.
When you talk about that, though, I mean, specifically in this, I think the point you're raising is the fact that the voting shares controlled by the founders, which is something we've seen increasingly in tech. But we talked about this before. You think that it's a case-by-case basis. If you know that the founders are the ones that you want to back, and we've talked about this with activist investors too, if they are the people that you want running the company, then it's not that big of an issue.
Right. And I think John and Logan are the perfect example of that. They really do think about the long-term growth and success of the business, how they partner with their drivers, and there's been criticism there. And for shareholders or investors that are coming in to make money, there's going to always be a conflict of interest. So who do you really want to trust with the growth of this firm? The founding partners that have continuously been thoughtful, taken it to an IPO, had not had the tumultuous story of Uber, or now outside investors coming in that are hedge fund managers and, passive investors.
But on that point, I mean, Lyft is interesting to me because the enemies are already inside the gate. I mean, two of the most, I think, terrifying active investors in the world,
Right.
our colleague Henry Kravis, they're already on board. I mean, that's fascinating. And so for me, the idea is that if they're going to uncouple spending and revenue, those guys are not patient, nor are they young enough to be that patient. And and I think there's an idea like, those guys are not quiet or patient or ready to, they're scary dudes. So I mean, is there any concern there?
Well, I think there's an irony that they are intense individuals, but you haven't seen them come out, speak publicly on Lyft as one of their investments. They haven't taken control of the board. They haven't kicked out the CEOs. They've allowed
They weren't public. I mean, like,
No,
this.
but even I think when you look at how Lyft's grown their business, you would think that those investors would say, you need to go overseas, you need to acquire, you need to be more aggressive on pricing, stop doing these carbon credits and making these rides carbon neutral, that's my money. And they've never done that. So I think that's actually something to be said about who the CEOs and senior management is within the organization, that these investors that are some of the most intense activist investors in the world are maybe actually taking a back seat.
Nice. I like the pun. We're going to end it on the pun because that's the best one we're going to get out of this segment. Anna Marie Wascher, thanks so much for joining us.
Thank
Appreciate
you.
it. And congrats, finally getting to the public market.